Welcome to this overview of topic 6.2, which is the economic climate. I'm sure you've heard on the news and read online about the economy. The economy is basically, it's the state of a country or region in terms of the production and consumption of goods and services and the supply of money. So it reflects on, it's about the level of business activity in a region or area. So if people say the economy is doing well, it means that people are buying goods and services, businesses are starting up, businesses are doing well, people are using products, they're going out and buying things. So that's what we mean by the economy. It's the financial performance of the business activity in a set region or area. So a town can have an economy. So you might say Spalding's economy is doing really well at the moment, or the economy of South Lincolnshire, or the European economy, or the UK economy. So it can be a region or area, and it's the financial and business activity within that area. That's what we mean by economy. Now, linked to this, you sometimes hear on the BBC News about the economic or the economic climate, which is about the state of the economy that a business operates in. So how well is a country doing in terms of two critical things: employment, so people working, and income. So money that people have available to spend, that they earn. Now, income can come from your wages or your salary, or it can come from assets. So you might rent out a house, or you may hold shares in a company. They generate income. So that property and those shares are called assets. Okay. The economy is often measured in what we call gross domestic product, or the GDP. So the GDP is the total value of all the goods and services manufactured and produced and sold within a country. So you talk about the size of an economy. So the US economy is probably bigger than the economy of Ireland because it sells and makes more goods and services. And it's shown as a percentage value year on year. So if you say that GDP grew 10% compared to last year, it means that 10% more goods and services were manufactured and sold within that country in that period of time. It is just a way of measuring the size of an economy. So you can talk about an economy as growing or shrinking, or one country's economy larger than another, and it's based on their GDP, gross domestic product. When an economy slows down as a result of its GDP falling perhaps, and unemployment is rising, and people stop spending money and business activity reduces, this is called a recession. Consumer spending, so the money that we spend, usually falls. And people often in a recession don't worry about luxury items, and maybe they'll focus on spending their money on basic brand items and essential items. So these are the factors, the characteristics of a recession, which is a slowdown in economic activity as measured by a country's GDP. So what might happen in a recession is that people's incomes fall. Maybe they earn less, which obviously means lower sales for businesses, which means that some businesses have to reduce their production or their output. And that means their human resources needs change. Maybe they don't need as many people. Maybe they make redundancies. Maybe they lay off workers. Maybe they put a freeze on wages or overtime. So this is what happens in a recession. Here's some interesting questions to ponder. When in business, can rising incomes, so people are earning more, have more money available, sometimes lead to a fall in sales? And vice versa. When can falling incomes, so maybe in a recession, lead to a rise in sales for some businesses? Think about the brands on this slide. Ponder that question. Now, in the last really big major financial crisis, 2008, which lasted 4 or 5 years really, some businesses did really well, or did quite well, compared to their competitors amidst this economic downturn. That's a nice way of saying a recession. Read the statistics on there and see if you can figure out why Lidl and Aldi actually did better than other supermarkets during the last big recession. Now, businesses need to change their strategy when incomes and employment fall, and this affects all the functions of a business. It affects the production function, the human resources, the finance, and the marketing. Have a think why. The production function of a business might need to reduce costs by reducing waste and increasing productivity. The HR function might need to reduce costs by improving productivity, laying off workers, making people redundant in an attempt to reduce their wages bills, their wages costs. When incomes fall and perhaps in a recession, the finance function of a business might need to reduce costs by taking out cheaper loans, for example, or trying to reduce its overdraft, and maybe looking for alternative ways of financing. Really interesting function to look at is the marketing function or the marketing departments of businesses. They have to completely change the marketing mix. They might have to look at the way they advertise. Do they need to advertise more or less? Do they need to produce a cheaper product? Do they need to look at their prices? So, promotional offers. Do they need to drop their prices? Do they need to completely change the marketing mix? So when incomes and employment rates fall in a country, so when unemployment is higher and people have less money to spend, that's called disposable income, by the way. Money people have to spend. If people have less money to spend, the marketing departments really have to think about their strategy. Change the marketing mix. Look at every aspect. Do we need new products? Do we need to discontinue old products? Do we need to change the prices? Do we need to review our advertising? This is a really good grade 9, grade 8 thinking exercise. Not about what a recession is, but how does a recession affect the various functions of a business? If people's income changes and employment levels fall, it affects different businesses in different ways. It depends how much people's average income changes by. It depends on what products you sell. It depends on how your competitors respond to these changes in the economic climate. And it depends on how your business responds. I talked about that about a minute ago, about the marketing department. How your business responds to fall or drops in people's average income and employment levels can very much influence your business's chances of survival. Another exam question to ponder. What about the impacts on business of rising income and employment? So when the economy is doing well, here's some words for you to think about. Businesses switch to focusing on maybe luxury goods, for example. Some of their products may see a fall in sales. Isn't that funny? If people are earning more money and the economy is doing well, sometimes you can see a fall in sales. What type of business do you think would see its sales fall if the economy was doing well? Sometimes that's called a boom, is when the economy is doing really well. Finally, a few basic GCSE level points about the international economic climate. A recession in other countries can really affect you as a business. If you export your goods to, say, France, and France was in a recession, the companies in France that you deal with, your customers, they might not want to buy your products anymore. They might not be able to afford that. So a recession in a foreign country can directly affect British business. If your trading partners are in a recession, what about if your suppliers are in a recession, for example? That might affect their prices. But importing, so buying goods from abroad, and exporting, sending goods abroad, is really affected by the international economic climate. Okay? Use words like trading partners. That's a really nice phrase. You know, relationships with our trading partners have changed because of the downturn or the boom in the international economic climate. And then, of course, there's Brexit. Look, Brexit in a nutshell for GCSE students of business. So, the European Union, 28 countries, 500 million potential and existing customers for your business. That is a huge market. When you import goods, so you buy goods from overseas, there is a tax on it, which is called a tariff. Now, these tariffs are very favourable. They are low rates at the moment because we're all part of this club, the EU. The worry is that if we leave the European Union, British businesses will have to pay more to import foreign goods into this country. So if you rely on France, Germany and Italy to buy your raw materials for your products, it's going to cost you more to buy them. Equally, it will make it more expensive for us to export our goods to these European countries. And it might just mean that foreign companies stop buying some British goods and services. That's the worry. None of this is 100% certain yet, but that is the concern. The second worry is, will we be able to work in other European countries as easily as we can now? Will people be able to move around Europe if Britain leaves the EU post-Brexit? That means it could be harder for British companies to employ and recruit foreign workers. It could lead to a skills shortage in this country. It could lead to increased recruitment costs because it might just be harder to find people to work in your company. And finally, supply chains. If your suppliers are based overseas, the logistics of moving goods and services around Europe to and from these countries might just be more complicated and more expensive after Brexit. That, in a nutshell, those are some of the worries that British companies have at the moment.